Good morning and welcome to the Monday Call, brought to you by NZ Funds. Inflation, the invisible thief, reduces the purchasing power of your money. As the cost of living increases over time, it can be a challenge to preserve the value of your savings. To address this, NZ Funds maintains the inflation category, a portfolio series with investments specifically selected for their ability to grow earnings above inflation over the long run. This includes global and domestic investments across infrastructure, utilities, and property. This morning, Mark Brooks, Chief Investment Officer, and Casey Keiper, Portfolio Manager at NZ Funds, join us for a deep dive into the inflation category. We will discuss the role of inflation assets and defensive shares in a well-constructed, diversified portfolio, explain how NZ Funds invests to mitigate the impact of inflation, and share case studies from NZ Funds' inflation category. Good morning, guys. It's really great to have you on the call. Let's kick off with what is the role of NZ Funds and the industry as a whole? We've touched on this a few times in the past, but it's always a really good place to start these sorts of discussions. And then from there, we'll build into more inflation category orientated points.
Sounds good. Morning, everyone. As you say, Stephan, it's something we've touched on before, but I think it's worth repeating because at the end of the day, I think, as I've said many times, our industry is pretty poor at sort of saying what its role is and what we're trying to ultimately achieve for clients. Simple fact is that for most people, leaving their money in the bank in cash is the default. That's the default asset class. And that's fine over shorter periods of time. But we know that as time goes on, cash does not beat inflation and it doesn't compound the way other asset classes can. And at the further up the risk spectrum, when you move into things like property and shares, they have those returns that are 7, 8, 9, 10% per annum on average. And if you start to compound that, compound 7% over 10 years means that you double your money. That's ultimately the role that our industry is trying to do. Now, shares are very much, that is the riskier end of the spectrum. Doesn't necessarily mean that over long periods of time that risk is a different concept. Over longer periods, they're actually less risky. Short term, they're risky. But we also build portfolios for clients at different age and stages. And the inflation space is really about sort of finding that mix between assets that do compound and ones that will beat inflation reliably over time. So that's why we call it the inflation space. But ultimately, our goal, stepping back, is to encourage people out of cash because that's not a long-term solution.
Okay, so when we're talking about long-term and short-term in the context of inflation assets and cash and shares, would you mind giving our audience a sense of what you mean? So are we talking 20 years, 10 years, 5 years? How do you think about the timeline?
Essentially, probably 5 years plus is really the point that we're starting point. And again, it is that compounding issue that comes back to at the first point, is that even in an environment that we've seen higher inflation, 1, 2, 3 years, it can sort of dent your earnings power. But really it's over that sort of 5, 10-year period that really starts to impact. Again, if you have 4 or 5% inflation, that really starts to impact the value of $100 in 5 years or $100 in 10 years' time. So that's really where the inflation space is positioned.
Right. One of the items I often hear from advisors is how frequently clients underestimate their time horizon, and they, you get to 65 and you think, I might be thinking of scaling down at my work and looking forward to the future. You probably have 15, 20, 30 years ahead of you, and so that is. That's a lot more than 5 years, obviously, and it's multiple business cycles, and so it means then that you need to look at assets beyond, just cash to make the most of.
And the reality is, we all know life moves fast. I was at a presentation last week and caught up with one of our referrers who we've had a good relationship with over the years. Actually worked out it's been 10 years since I've sort of seen him. So time goes really fast when you don't necessarily, when you're doing other things, and that's the key.
Okay, so then within the inflation category, we use the word defensive shares. How do you think about those two concepts, and are they the same thing or are they slightly different?
Well, for defensive assets, it's an interesting. I think perhaps the best way to illustrate it is by comparing it to what isn't a defensive asset. So if you look at, the broad market index, the S&P 500, that's what you might think of as a broad sort of growth asset portfolio. And those assets are primarily driven by their capital return. And so a large portion of your total return comes from that capital return. There's not a high level of dividends in there. If you look at the defensive assets, the ones that we hold within the inflation category, things like property, utilities, and infrastructure, and we've done empirical analysis on this, is that a large chunk of their total return comes from those stable dividends that grow slowly and incrementally over time. So that's perhaps one of the best ways to look at it, and that's just from a return perspective. But then you actually look at the type of companies that these are, and these are your things like your hospitals, the things like industrial property, utilities, things that are very resilient in an everyday world where people still need to turn the lights on, people still need to go to get healthcare treatment, people still need retirement villages, all very resilient assets that are sort of slightly leveraged to the economic growth of the world, but offer quite a stable earnings and cash flow profile.
So as a group of assets, because within them, obviously earnings goes up and down through time for each company, but when you have a portfolio of those assets, that's the stability you're referring to.
Correct.
Yeah, and I think to me, there's sort of two things that jump out from Casey's comments there are, one, that stability, and two, the growth. And if you think about the different asset classes, and as you move up through the risk spectrum, start with cash, next bonds, and at the riskier end, you've got shares. Really sitting in the middle are these defensive shares that in many respects you can actually call growth bonds. And they have bond-like returns in terms of their, they generate relatively stable earnings. But the important part is, unlike a bond, they have the ability to grow those. And that's where that function of being able to sort of beat inflation comes out of these assets, really that growth component, a degree of stability, but also growth, which is the key part.
Okay, so you touched on the nature of the revenue stream and the earnings profile, that it tends to be more stable, and obviously demand from consumers will continue in most environments. Are there particular company types? So you mentioned healthcare and some property and other infrastructure. What else is there within that kind of bucket?
I could talk about this for hours.
We'll give us we'll dive into some of the companies.
40 minutes.
Yeah. Maybe at a very high level, it's things that you see and use every day. It's your toll roads, it's your ports, it's your seaports. That's the bedrock of it. Every time you turn on your phone, that's pinging off to a cell tower, the whole telecommunications industry. Every time you turn the lights on, the whole utilities industry. It's things that you touch very often during the week. And all those kind of assets are things that we like to invest in this category, because we think it provides a great way at mitigating inflation over the long term.
So one way to think about it is they have sort of a commercial moat, be it a regulatory monopoly or a natural monopoly, or some sort of the capital to actually achieve what the infrastructure assets they have. It's very hard to build a dam, for example, and it's very hard to build a new airport. Are there other types of sort of a lens through which you look at it? It's just usership. Is that right? Or, yeah.
Yeah, so if we look at the infrastructure category as a whole, that's sort of split into three super sectors, I guess, which is data infrastructure, transport infrastructure, and environmental infrastructure. And so data infrastructure, those are things like your data centers, your fiber lines in the ground like Chorus, and the satellites in the sky. And within transport, that's what we just touched on before: your roading, your ports, your freight, and your rail. And then with environmental, it's things like renewables, solar panels, and waste collection, all things that are very solid and offer those sort of infrastructure characteristics that have very high barriers to entry, and do have that sort of regulatory or a strong moat of some kind, which gives them protection and resilience, not only in times of growth, but in times of weakness as well.
And so they'll be linked to things like immigration growth and GDP growth at the same time, as well as other sector-specific positives and risks.
Yeah, and that's been, frankly, one of the challenges over the last couple of years. New Zealand shares have really traded sideways for about 4.5 years now. Some of that is because New Zealand shares definitely got very expensive into the COVID period, but it's also a reflection that, as a market, New Zealand is quite heavily weighted to these types of defensive-natured securities, and actually the GDP growth's been relatively slow over the last 3 or 4 years, and with the Reserve Bank having interest rates high, that has weighed on those sorts of on the wider market and those sorts of names as well.
Yeah, okay. So take us through a couple of the cons and pros, and pro-cons, if you will, when it's not that obvious, of the category, please.
I guess maybe the first thing to mention is that the category as a whole does have a large weighting to shares, and shares are shares first. So they do have higher volatility than a bond or cash, and perhaps more than a traditional sort of 60-40 portfolio. But so the price you pay is that near-term volatility. But given the studies, longer-term studies and the shorter-term empirical studies that we've done, we truly believe that that's the best way to mitigate inflation over the long term. And perhaps that segues into, that's the con, but perhaps that segues into over 3 years, 5 years, and 7 years. What does it look like against cash?
Is it worth sort of stepping back and saying, well, you use the term a 60-40 portfolio, that might be something that some people are unfamiliar with?
Yeah, sure. So I guess your traditional 60-40 portfolio, you've got 60% of your normal growth equities that we touched on before, so not necessarily those defensive assets that we hold within the inflation category, and then a 40% allocation to a mixture of corporate bonds, government bonds, and cash.
Yeah. And really, in that sense, to get a blended outcome between assets which are more stable and generally do better in bad times, bonds and cash, and the more growthy assets, the shares, that do better in the good times. I think one of the, and I know I'm going to steal your thunder with this, the in a way, the dirty little secret in New Zealand, though, is that 60-40 portfolio has some big issues on an after-tax basis, doesn't it?
Exactly. Because your income assets, they're taxed fully at your marginal rate, whereas you've got those advantages with shares.
Yeah. So again, in New Zealand, we've said a number of times, if you think about the tax structure for shares in New Zealand, it is very friendly. Corporates in New Zealand pay tax, and assuming they are paying the full tax rate, which isn't always the case for various tax reasons, but in most cases they will pass on imputation credits for all of that tax paid. So if you're an end shareholder, owner of those shares, you effectively receive that tax-free as long as it's fully imputed. So there is no tax, unlike the bonds.
As long as you're in a pie, though, right? If you receive them outside of a pie, so a portfolio investment entity, it's one of the structures through which you can invest, and NZ Funds only uses pies, but there are other structures, and including holding direct, in which case generally your marginal tax rate rather than your PIR or your pie tax rate applies, and that means you could have to top up, say, a dividend that's received from 28%, which is the top rate in a pie, to, if you're a trust or a high income earner, 39% or 33%. So But there are other tax benefits, right?
Yeah, and then if you come back to, half the portfolio are made up of New Zealand assets, the other half are offshore assets, and offshore shares are taxed under the fair dividend uh, process, and regime, and it's the word I was looking for. And in that sense, it assumes a 5% tax rate. So in a pie structure, you're going to pay 28% of that. So broadly, nice round numbers, 1.5% of that. So from that point of view, again, the tax is very minimal. And coming back to that earlier point about the time frame, think about that wedge that creates. If you can create that tax wedge by owning the right sort of assets, over time that wedge is going to compound. And that's a key part of why we do think this space in terms of and focusing on defensive shares has a real ability to beat inflation consistently over time once you move out of that sort of 2 or 3 year time frame.
So Casey, you mentioned empirical studies, and obviously, Mark, you've talked about timeframes. Take us through at a high level what you've been trying to unpack there.
Yeah. So I guess one way to look at it is we wanted to look at how inflation assets would perform against cash or cash and bonds over the short term, the medium term, and the long term. And because we have a unique structure here with our inflation category being a mix of property, utilities, and infrastructure. So what we wanted to do was test our blend of property, utilities, and infrastructure, and the blend between global and domestic. And what would that look like if we went back over, say, 16, 17, 18 years of data? And what the data showed was that if you, over a 3-year period, the inflation asset portfolio might have like a 50% chance of beating inflation, or lower than 50% chance of beating inflation, whereas your cash portfolio might have a higher percentage chance than that, or a better chance at beating inflation over that very short term. But as you move out from 3 years to 5 years, 5 years to 7 years, 7 years to 10 years, you see almost that that parabolic relationship where the longer you wait and the more patient you are. It's based off our data at 7 years beyond, it was beating inflation by a margin of 1% or more. So,
Righto, and so that says again, it's you've got to let the compounding take place, and you've got to expect that there will be difficult periods, which is that 50% in the beginning, say, and then but over the longer run, it's not even the long run, the longer run, that plays out.
Yeah, just jumping in there, I think it's a really interesting stat I saw the other day from I think it was CoreLogic in their Q1 house sales data, which sort of came back to that idea that it's really time that creates gains through that compounding. And they looked at properties that were being sold in that quarter. What was the average holding period of those properties versus properties that were being sold? And ones that were sold at a profit, the average holding period was 8.8 years. The ones that were being sold at a loss, the average holding period was 2.4 years. And again, that sort of just comes back to that point that the longer you hold something, as long as you're getting those, you've got the right asset to start with, the longer you hold it, the more likely you are to sort of reach your goal and your target outcome.
Righto. Okay. So what are the other pros and cons of the category?
Well, perhaps one point to look at is that shares are nominal instruments. They're nominal assets. So if you've got, here in the investment team, we often like to look at real numbers and stripping back the impact of inflation to get a real gauge of how things are going on. But the reality is that inflation, the shares themselves don't really care about inflation from an earnings point of view, and that so if your nominal GDP over time is around 4.5%, and these inflation assets are typically GDP plus type assets, they're able to grow their earnings at around GDP, and then you add in a little bit of operating leverage or some productivity improvements or efficiency improvements, and they generally tend to deliver 1 or 2% above that. And so they've got this natural sort of mechanism to get that kind of growth over the long term. And whereas if you compare that to something like cash and bonds, where your return can be locked in from the very beginning, that you don't get that sort of same growth effect like you do with the defensive shares.
Yeah, I think it is a point that's often missed, even by those in our industry, that the economists, I think rightly so, want to look at what is the real change. So take out the price changes, trying to get to the heart of is an economy growing? But at the same time, you need to bring that back in and think, well, yes, as Casey said, on average, economies grow at 4 to 5% per annum. And that is something that's often forgotten. And shares naturally capture that inherent growth.
Now, just on there, a lot of people say New Zealand economy doesn't grow at 4 to 5% per annum. I mean, we haven't experienced that. That's the difference between nominal growth and real growth, right?
And even where at the moment we are, basically the economy's flatlining at a real level. It's been going backwards a little. It's been going, the most recent number was a small positive, but that is after inflation. After taking out inflation. And we've had inflation of 4%, so that basically says, 0 plus 4 is 4.
Yeah, okay. Those traits, the ability to increase productivity and efficiency and so forth, they apply to all shares, not just inflation shares, right? So how on that front do they have any differences that you think? Is it simply the fact that they are able to pass on costs more easily? You mentioned earlier that people will keep turning on the lights, but people, for example, don't keep going to retail outlets when times get tough, and they don't keep going to the movies or whatever it happens to be. So there's is that ability to keep eking out earnings growth something a function of the nature of what they provide?
Yeah, I truly believe so. I mean, a lot of this, not all of it, but a lot of it is critical infrastructure, where day in, day out, it needs to be used. And another feature of these assets is, if you looked at a portfolio screen on the inflation category, you might think, oh well, the debt levels here are actually higher than average compared to your S&P 500 or your broader growth stocks, but there's a very good reason for that. Is because they have these such strong and stable cash flows that they are able to, have a higher LVR ratio, I guess, if you made it analogous to property, where because they've got such a strong ability to service the debt, they can have a more efficient capital structure potentially, and use that to their own advantage. So it's not only the nature of their business, it's the high amount of capital within the business. And those are sort of two reasons why, in the last sort of 12 to 24 months, where we've had a massive increase in interest rates, and the sector has struggled because that's sort of the nature of the companies. But again, as we expect interest rates to come down, again, they would get that sort of, well, we would expect them to get that uplift as well over time.
Yeah, so they kind of get that sort of double benefit. One, yes, they are interest rate sensitive because they're bond-like in their cash return, in their cash flows, so you would expect it to have a relationship with interest rates. So if interest rates moving up is not a good thing, interest rates moving back down is positive. But equally, think about that demand side, and you sort of touched on, can they sort of grow their activities? What's happened in New Zealand over the last couple of years? We've had a couple of big issues here. One, most recently, population's grown by 2.5%. That does mean more roads. It does mean more electricity demand. It does mean more internet demand. All of that requires more investment, which, certainly in the regulated entities, you would expect the regulator, Comcom, to say, yes, there is a need for that, so you can go and spend that and you can get a return on that. Equally, something like the floods last year in the Hawke's Bay, it's very interesting that for really the first time, something like Chorus, internet was actually talked about as a utility. And again, it's about sort of building on resiliency on the back of issues like that is ultimately sort of positive for the growth of these businesses going forward.
Okay, you mentioned the interest rate cycle and the impact that it can have on valuation of the assets. I also know that you've also shared some enthusiasm about them and the future over the next few while. Can you take us through why you're excited about the category and what are the particular elements of the different categories that I guess lend towards your positive perspective on it?
Sure. Did you want to jump into sort of perhaps one of the subcategories?
Yeah, go for it. Yeah, maybe we'll start with infrastructure.
Yeah, infrastructure. Well, I'm sure if anyone's listening from Auckland or New Zealand, will know that there's a bit of an infrastructure gap, a bit of an infrastructure deficit. Whether that's roads, rail, ports. If you've ever tried to go through the customs line late at night at Auckland Airport, you'll know the struggles. But it's across the board. There's a deficit there, and it's the same globally, where the world needs more infrastructure and more efficient infrastructure, and it's also one area that governments really like to invest in times of weakness as well. So those are sort of two strong areas of why we're excited about infrastructure. Is that if we want to develop and grow as a nation, as a world together, that's where we need to invest in and put a lot of work into. And the type of infrastructure that we invest in it's not just, I touched on it earlier before, but it's not just the boring, well, I think it's interesting, but some people might think it's boring, things like toll roads and airports. But it is things like data centers and renewable energy. I mean, you look at the example of Infratil here in New Zealand. What an amazing and fantastic company, a New Zealand company that's been able to expand its position and presence across the globe and really have a meaningful impact through its investment in telecommunications and data centers and renewable energy all over the world. I mean, they're one of the pioneers or leaders in solar development in the United States. Like, how cool is that? So yeah, there's a lot of things to really get excited about in the infrastructure space, and I think infrastructure sort of ties quite well to utilities. What's happening in the energy space and over there as well. If you wanted to add anything onto that.
That sums it up pretty nicely. Yeah.
Cool.
Are there any particular infrastructure projects that you think New Zealand has underway that look exciting to you from an investment perspective that you can invest in, or is there something you would like to see, particularly of all the different categories you mentioned, for New Zealand Inc. to build?
There definitely is specific things that are exciting and that we do and can invest in. But maybe if I just take a quick step back, and I think New Zealand could go a long way in terms of making the infrastructure investment more accessible to people like us, to your everyday person, of getting exposure to that infrastructure and perhaps help fund some of that infrastructure that we need. A lot of these, I mentioned Infratil, but a lot of different infrastructure sort of projects and partners sort of sit outside of that public space and that public realm, and it's hard to know what's going on with the projects. How efficient are they? And some of them, we'd really like to get involved too, but just can't because of they're not publicly listed securities. But one point I'd highlight about something that's quite interesting and exciting is you look at Infratil. Again, more specifically, they have a portfolio company called Canberra Data Centers, or CDC. And just the other week, they did a massive capital raise. They raised $1 billion to fund expansion of these data centers, both in Australia and New Zealand, because the demand is so strong and it's just outstripping supply. And usually, sometimes when a company comes to market and tries to raise $1 billion, doesn't always get taken that favorably by the market. Who's thinking,
especially in a market this size.
Exactly. But you see what happened with Infratil, and they just had unbelievable support for this kind of expansion and development. So when a stock would usually trade down after its capital raise, we had the exact opposite happen with Infratil, where more people became aware, or more attention was brought to it, especially from offshore people, about the exciting opportunity that they have here. And the work they do in those data centers is top tier. They're not just plonking them down wherever they can find space. It's making sure that they're the highest quality of safety, the highest quality of efficiency across the board, and also sustainability as well.
Okay, and other countries, I think, just thinking across the ditch, they have business like Transurban, which is obviously a larger infrastructure and toll road provider. We don't have anything equivalent to that in New Zealand, do we?
Not yet. But if you think, I think that is one of the challenges for New Zealand is we do have an infrastructure deficit, and it's about trying to work out how best to utilise the capital that we have here. And KiwiSaver has grown massively over the last couple of years, and it now is a very real saving space to put into things like that. It's just about finding the right framework and avenues. And again, I think if we look at some of the largest listed companies in New Zealand, you look at the utility, the electricity producers, they're half owned, or most of them are half owned by the government. You look at something like Chorus, ultimately that business and the fibre backbone of New Zealand was very clearly the result of a government initiative, and they had a lot of influence in terms of the funding of that. So I think there's no reason why we can't move towards something like a Transurban that they have in Australia that owns toll roads. And clearly the council here in Auckland wants to sort of move towards some form of congestion charging, be that toll roads or not. As Casey said, we'd really like to be part of that and help grow New Zealand through the capital that we and other KiwiSaver providers have.
Okay. Utilities is another category. So we've got infrastructure, utilities, and properties as the three sort of subcategories. And you touched on data centres, but that feeds into a broader theme within the utilities category that you're seeing. Take us through that and what you think it will mean for the category, and I guess more generally for how we consume the services over time.
Sure. Well, I guess the big theme across utilities is quite similar but nuanced in comparing it New Zealand versus globally. But the big theme is electrification. In New Zealand, we're getting a big electrification wave that's driving real demand growth that we haven't seen in decades, really. And that's things like converting your process heat into electric processes. Fonterra is a big user of process heat, and converting those systems and those processes into electric ones takes a lot of work, takes a lot of time. But that's adding every incremental demand to the grid. And the one that most people will be familiar with is EVs. Every EV that you add onto the grid, I think the grid wouldn't quite like it if everyone plugged their EVs into the wall at the very same time. So that's an area that needs investment, but that's also an area that a lot of demand is being added. And then also, data centers themselves, these things consume and drink a lot of power. And there's also a big emphasis from your likes of the customers of these data centers, your Amazons, your Googles, your Microsofts, that want clean energy or green energy. And so that's what I think how we're looking at it, and we're doing well in that area of, given our ESG policies, where we're focusing on those companies that are doing the right thing or making great strides to be the best in their fields. So, maybe taking it to one example around a data center. If you look at not even the leading chip anymore, but the NVIDIA H100 chip, that consumes about the same or more power than the average American household. And if you look back at 2023, if you average it daily, they were deploying about 1,500 chips into these centers every single day. So you can imagine adding 1,500 homes to a grid, what the sort of impact could be from that. It's quite momentous, and something that the surrounding infrastructure needs to improve, but also for the utilities to be able to supply that infrastructure. And in New Zealand, the utility sector here in New Zealand, we recently got the announcement around TY that the NZ aluminium smelter is going to be around for a minimum of 8 years or 8 to 10 years, including the cancellation with options going to 20 years. That's a cornerstone power user that also enables the rest of the sector to put more money into really good projects like adding new wind turbines, adding new solar plants, to enable that future growth that we're expecting from all those underlying demand factors. And this is not something that we think is going to be gone in 12 to 24 months. This is a 5, 10, 15 year plus story. So that's something that we're quite excited about over the medium to long term.
Yeah, and I think, again, being here in New Zealand, often it's hard to, or we sort of forget where we are in terms of positioning at times. Certainly maybe our EV adoption is not as fast as other places, but we still come from a situation where the vast bulk of our electricity is already renewable. We have the luxury of hydro. And there's already, to a degree, a relatively strong electrification use, certainly at a residential level. You think of people have heat pumps. Increasingly, they're moving to, say, to convection ovens over gas, etc. You can sort of contrast to somewhere like the US, where vast bulk of heating still happens through gas or even oil-based, and heat pumps are quite a novel concept in many respects. So they've got a very big change in their electricity usage going on there. And then at the supply side, a lot still comes from coal or natural gas. So there is that need to transition more and more of the supply across. So all of that from a utility provider point of view just means they've got to build more. There is more demand coming, even before you get to that sort of potential hockey stick of the data centers and the AI demand, where what was the stat about an AI search versus a Google search?
It's remarkable. 6 to 10 times more power that a basic chat GPT query takes versus your normal Google search. And anecdotally, I know more and more people are using tools like ChatGPT as a way to bypass the Google search experience. It's being used on a daily basis by many, many people, and that's just one small area that's driving demand.
Well, the good thing is I use it all the time now, and I only do use it 1/6 of the time what I need to search as much, or I only search 1/6 of the amount to get to the answer.
But it is that point that it is getting used. Yeah. I saw some clients the other day who have an online business, and all of their questions, they said, get on their website, because their website's quite detailed and quite specific in terms of what they're selling. All of it is answered by an AI chatbot, so it is getting used. It is coming into data use, which is the important part.
Yeah, and you might not see it yourself, right? You might not. You could say, oh well, I only do a couple GPT searches a day or a week or whatever, but you log into your internet provider and you need help with an issue, and bang, there's a chatbot behind that is feeding your prompts through the large language model and giving you an output. And every time that happens, that's power demand.
And I guess the other point of, that's all happening in addition to, X number of houses coming back onto the market or coming onto the market, and all the other GDP demand increase through the system that, the power gentailers in New Zealand and power suppliers elsewhere need to provide for.
Yeah, so coming back to that, growth bond, it's got that bond component, but certainly in the utility space, that growth is likely to be much higher than it's been for some time. I think, what was the number? I think US electricity growth's grown at about 2 to 3% per annum for 20, 30 years, and it's forecast to be about 9 going forward over the next 10, which is light years different in many respects.
In some markets, and I'm just a quick segue to the side here, but in some markets, when you get a small increase in demand, you get a big change in price, right? And it'll be interesting to see how the power, I guess, markets respond to this. And immediately comes to mind places like the UK and Germany during the early days of the Ukraine special act, whatever they called it, war, and how, yes, there was a reasonably significant reduction in supply, but it just led to a massive shift in price. So similarly here, if you have a 9% increase in demand and you've probably only got a supply increase of 3 or 4%, and that, well, theoretically that could translate to quite a big shift in price.
Yeah.
Okay, so property was the third category. Take us through that. This is quite it's got some idiosyncratic elements to it. There's obviously different types of property. You've got retail, you've got office style, property and commercial property, and you've got warehouses and factories and so forth, and all respond to the economic environment in different ways. How do you think about it?
I think maybe if I touch on global property first, but property can be seen as quite a sensitive asset to interest rates, and it is. And people might think that property or real estate can be quite volatile, and it can be. But I think if you look at our global property portfolio, you get a really good mix of all of these different types of assets. So they help smooth each other out, right? So you've got data centers that have these great exposure to growth and these themes that we're talking about with AI. But then you also have healthcare real estate, your hospitals and your medical centers, your radiologists, all across the board. And those provide really stable cash flows unless people are, stop going to the doctor or stop going to the hospital. And then there's also a mix of single family and residential homes. And this isn't just in the States, this is overseas as well. Like these massive, massive companies are quite well diversified in their own right. And then you add in all these different types of operating companies like self-storage solutions and industrial properties like warehousing and things like that. And I think you get a really nice mix of different sectors and different industries that are exposed to different things, but you still get that same underlying benefit or growth drivers over the long term for the property sector as a whole.
It might just butt in there, if you look at both New Zealand and the US in terms of the inflation numbers, the real challenge in some respects has been rental inflation. New Zealand is running at sort of 4.5%, and pretty sticky at that level. The US has definitely been of that level as well, and this is the sector that has exposure to it. And at another level, if you think about, say, the US being it's a very different place to New Zealand. They have typically their apartments are owned by a relatively small selection. The big apartment blocks are owned by a relatively small selection of very large listed businesses. That is a theme that's starting here, where you're starting to see the build to rent concept become more and more, and something like Kiwi Property is building or adding build to rent out at Sylvia Park, and sort of using their existing space and land banks to expand and change the nature of their portfolio from being, say, purely retail to one that's a mixed use. And again, that's a growth opportunity.
Definitely. I think you get so many different examples within the property space where, there's retail property within the portfolio. And the current sentiment right now is that, retail's not doing that flash. But as one area is doing perhaps a bit poorly, other areas are doing very strong, like the data centers. So I think that great mix really provides resiliency to maybe the short-term noise or some of those short-term impacts that you can face as well.
With retail or any sector, if you're a service provider to them, as retail property owners would be, it doesn't necessarily translate that while the sector might be having a hard time, that the providers of services to the sector are having a hard time. Presumably rent is still being paid for at least the major providers, and it will come down to the quality of the tenants they have. Okay, there's another subcategory, which is retirement villages, which sits underneath property. Take us through that. And you've talked in the past, Casey, about on the Monday call about why you think this is such an interesting and sector, and particularly has really strong potential upside for investors.
Yeah, so this applies to not only New Zealand, but the global property as well. There's some retirement villages and communities and housing in there as well. But perhaps it's a more understandable example, sort of focusing on New Zealand. Um, the very basic or high level trend that's happening is we have an aging population in New Zealand. And this aging population, the over 75 population is expected to be 4 times higher in decades' time. And so that creates an immense demand over many, many years to support these retirement villages and the need for their services. You combine that with trends of people wanting to spend more on their private healthcare, people wanting to sort of enjoy the amenities and the value proposition that a retirement village provides. You've got great communities there where it's very social, and there's no, I feel like we don't really get the same stigma around here in New Zealand around retirement villages. They're seen as positive places that you can hang out with your friends and but also make sure that you get looked after as well. So that in the event that if your health does decline, they've got fully fledged hospitals there. And so there are some challenges within the space at the moment. One of the big ones is that in order to move to a retirement village, many people have to sell their existing house, and the time taken to sell that house means you can't realistically move in until you've sold that house. And with the current residential property market that we have, it can take quite a while to sell your current house. So that's preventing or creating a bit of a lag in the sales cycle for those retirement villages. And then the other challenge that the sector has is they had such a great time over sort of the last decade and a half before COVID, where things were going swell, and maybe they got a bit too aggressive with their growth plans and their growth expansion. They started buying land up everywhere here and there, and once the market turned, they found that they were in a bit of a struggle. So I think those are probably sort of two key reasons of why the sector has struggled recently. But it's also, in our view, sort of short to medium term impacts. If you look at the long-term demand drivers and the long-term benefits that these retirement villages provide, that's something to get really excited about. And then you take it a step deeper and look at the fundamental valuations of some of these stocks. And some of these stocks are trading at, some of these companies are trading at 50% of their book value.
So the value of the properties.
Yeah, the value of the property. So you imagine your CV says $1 million, and it's on the market right now for $500,000. It's not quite as simple as that, but that's just one point to illustrate the kind of value that you could get if you're a patient long-term investor. I mean, I don't think many people would think in 10 years' time, in 20 years' time, is the government going to all of a sudden pop up, spend billions and billions of dollars and pop up their own retirement villages? Will they be able to provide the services? So it's not really an area, I think, that the public space can accommodate that kind of demand, which means that the private sector needs to step up and put more work into it. So while the next 12 or 24 months could be challenging, you extend your time horizon a bit, and that's where we see really attractive value across the space.
I guess it comes back to one of the things we say, it's sort of catch cry at NZ Funds is think decades, not years, and in that case it's 1 or 2 or 3 years. We probably don't even need to get to decades before we start seeing hopefully that particular sector having brighter days, and no doubt when the interest rate worm finally turns, it'll be more supportive. Okay, so Mark, Casey, thank you so much. Just to kind of summarize where we've got to, the inflation category obviously exists to help manage purchasing power of clients and assets through time, and it depends on It's in most clients' portfolios, but the extent to which and the size of the allocation will depend, depending on your particular requirements and needs and goals and so forth. We use defensive shares because for a range of reasons, but particularly in New Zealand, there's very supportive tax treatment, and over time, because we build longer term portfolios, they tend to outperform the alternatives, bonds and cash, whilst not being quite as volatile as growth assets in the traditional sense. And then we, as you mentioned, we have these three major categories. We've got infrastructure, utilities, and property, and a subcategory under property of retirement villages. And each of them have their own unique elements and way factors that we take into account in terms of building the portfolios for clients. Hopefully, I've paraphrased all of that.
Can I have a crack at doing the true cliff note?
Yeah, go.
Because I thought that was really good. Ultimately, I like this concept of the growth bond. The growth component will mean that you should, over time, beat inflation, especially as you've got the wedge of tax that we get in New Zealand. So hold it for at least a medium period of time, so 5 years plus, and that should give you a good deal of confidence that we have a good deal of confidence that these sorts of assets will be able to beat inflation over that time frame, and that's the goal.
Fantastic. You don't have a second cliff note?
No, I've tried to bed down my internal enthusiasm because I'm incredibly excited about this space. Maybe that one line from Warren Buffett: when others are greedy, be fearful, and when others are fearful, be greedy. And we're seeing great value in some places, so it's an exciting time to be an inflation category investor.
Great. Thank you, guys. Thank you.
Thanks.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.